So this is going to be a community discussion. We've never done this before, and we hope it can be a little bit more interactive and a middle ground between a panel and a roundtable component with folks interested in DeFi. So I'm Diana, I run research and sustainability at GBBC, and I am joined here by Lee, Filippo, Hedi, Bill, and Sylvia. If you can each introduce yourselves, what you're doing, and your organization. Let's get started there, and then Lee is going to give a fuller introduction. So Lee, over to you.
Thank you, Diana. I'm Lee Schneider. I'm the general counsel at Ava Labs. We work on the Avalanche public blockchain, and I've been running around doing blockchain and crypto stuff for quite a number of years now, and it's really exciting to see all the developments that are going on.
Thank you, Diana. So I'm Filippo Moraschi. I'm the community manager and strategist at Fox Finance. Fox Finance is a cross-chain lending protocol that offers a wide range of decentralized tools. And by using a messaging layer, so we are able to offer interoperable loans to our users.
Thank you. Hedi Navazan, Chief Compliance Officer of 1inch, one of the biggest aggregators in the DeFi scene as today exists. Historically, I've worked before with blockchain data analytics, Crystal Blockchain, and with a background I come from TradFi, working with HSBC, ABN AMRO, ING Bank in the domain of regulatory compliance and investigations.
Bill Papp, CEO of Polymesh Association. Polymesh is a public permission blockchain focused on real-world assets as it relates to tokenization.
Hi everybody, my name is Sylvia Sanchez. I am a project manager at Ava Labs, and I work very closely with Lee on our Owl Explains podcast, which is an initiative on blockchain education, policy, and everything in between.
Great. So some context here with our Global Standards Mapping Initiative, which is our yearly initiative within GBBC where we work with our members to compile resources, reports, and educational materials that are open source. We had a working group on DeFi over the course of 2024, of which we had the pleasure of having Lee be one of the co-chairs. Lee, could you give us an overview of what we highlight in that report and the most important themes for today to look forward into 2025?
Thank you, Diana. And we really do want to make this an interactive conversation, so all of us sitting up here will talk, but we want questions from the audience, we want input from the audience. So if you hear something that is said that you agree with strongly or disagree with strongly, please raise your hand and join the conversation. I find often just sitting and listening to panelists gets a little boring, so we want to do something a little more exciting. And I'm going to start calling on people in the audience if nobody says anything. I'm looking at you, Norma. No. So in working on the project, by the way, Diana had a huge role in the project. She always undersells how important her role is. What we really tried to do was, instead of come up with some regulatory regime for DeFi or proposals around regulation for DeFi, we really wanted to talk about the nature of DeFi, and in particular, the different actors within DeFi overall and sort of their different roles and what the risks and risk management might be that's associated with that. And we started the report by talking about what we thought were the four most important themes. One is the fact that there's no intermediaries in DeFi. In other words, intermediaries are not required. It's all about autonomously functioning code. Two, everything's global automatically. And the last panel, I thought it was really good to have such a diversity of people because we heard different perspectives about what's going on in different jurisdictions, and not everybody in the world is thinking about all of this stuff the same way. And DeFi is an example of that. The third theme we came up with was the importance of infrastructure. The physical infrastructure and the software infrastructure that goes into making DeFi work. That includes the computer that you use to interface with DeFi, and the importance of the communications architecture in the world, the importance of having free and open access to the internet. Free not meaning doesn't cost you anything. Free meaning it's uncensored access to the internet. And then the fourth theme was really stressing the importance of the code, right? People need to read and understand the code in DeFi protocols because it is functioning autonomously, and there's nobody you can call if a mistake happens, if a hack happens, if the system gets gamed. And we've seen all of those things over the last several years. And so with that context, we then dove into a lot of thinking that the team had about DeFi, and in particular about the different roles within DeFi, including the infrastructure providers, including the market makers and other liquidity providers, including the software developers. What we were trying to do is capture what this ecosystem looks like, capture who is participating in DeFi, and the importance of each of their contributions. There was a paper that came out at the end of last year from BIS that analyzed liquidity provision in DeFi and found that about 80% of the liquidity provision is done by professional market makers. Now, we can say that's a good thing or that's a bad thing. That's what is intended with DeFi or not intended with DeFi. But that's the facts of what's happening. And so one might say a major risk in DeFi is the fact that too much liquidity provision is happening from market makers. And if they abandon the marketplace, then that marketplace dies. So we look at all of these different aspects of DeFi in the context of the report. And again, we didn't try to come to any real conclusions. What we tried to do was bring all of this together in one place.
By the way, you can access the report on DeFi at gbbc.io/GSMI. And there's a section on reports and fact cards, and you will find it there. So I'll turn it to Sylvia. What question do you think we should start with?
I think that having this in mind, we should obviously talk about intermediation. So I'd like to first ask our panelists and then open it up to the audience if should DeFi protocols or any elements of protocols like decentralized exchanges be necessarily treated as intermediaries?
It's maybe I can comment on. I mean, from different aspects, when we look at what we have in terms of regulatory requirements on financial institutions and how DeFi by far has been excluded from those regulatory requirements, specifically under FATF recommendation, the moment that you are acting as an intermediary in a financial transaction, you would fall under the full requirements, both on compliance, anti-money laundering, you name it, because you are an intermediary. That's what we see with centralized exchanges. That's what we are seeing with TradFi. Even we have had in Europe, I don't know, it was around, I think, 8 years ago, to my memory, I was involved with PSD2 regulation. There were times that we had ADN and payment service providers which they were intermediary of transactions, but there were no regulation, adhere to them. And then we had PSD2 requirement in Europe because you are considered as an intermediary of in a financial ecosystem. Then we have companies like, I give the experience because in my career, I just saw everything happen one after the other, and now we are in a crypto and digital scene, a digital asset scene. We have also companies like Plaid, for example. They're providing infrastructure, right? They are in the behind of the transactions, and they are not intermediary, but they also needed to get licenses from, for example, Dutch Central Bank or other central banks. Then we have decentralized, we have protocols, or we have players like 1inch, which we are also providing infrastructure. We are not charging any, for example, fees on any trades, on any swaps. It's all without any fees or gas fee involvement, but we are providing infrastructure to centralized exchanges to use our infrastructure in order to connect with various protocols and get the best rating for their users. In one way or the other, we are intermediary, and one way or the other, we are not really intermediary of any transaction. But I want to be very careful, because even with us, the approach we are taking, I think if we are playing a major role in a DeFi scene, there must be at least bare minimum requirements. And if we go through the numbers, which I actually got from our data analytics, if we just look at and this is only 1-inch numbers, so you can compare to our competitors like Uniswap. We have had, in December only, 19.3 billion total volumes swapped through 1 inch in December 2024. This is quite a number if we are even considering still traditional players, institutional players like JP Morgans of the world. They have not yet fully get involved, and the average monthly volume is 12.9 billion US dollar. These are numbers that we are talking about, in the financial ecosystem. So it's a bit of a balance act to what extent we see DeFi players as an intermediary, but I would not call DeFi players a pure intermediary. And I don't believe the same requirement on centralized exchanges would definitely not be applicable to the DeFi world.
Thank you, Filippo.
Yeah, I can comment on it. So having an intermediary goes to the ethos of decentralization. And when we refer to intermediaries, we are referring to facilitators of transaction or facilitators that help you in managing the assets. These introduce points of control and inefficiency in your operation. In DeFi, this is replaced by smart contract, so everything is automated. But in DeFi, there is also still some point of control, especially when we refer, for example, to the team. The team sometimes have control in updating the contract. So most of the project don't say it, but the more expertise users can see it by looking at the code. But potentially some team can update the contract without other user knowing about it. On Fox Finance, for example, what we care the most is the security of our fund, the user funds, and we invested a lot into the security of the asset. I'm trying to shilling a bit because we really invested on it. And there are basically 3 main risks in DeFi. The first one is economic risk. So every DeFi protocol should set parameters that help the user in having like a smooth transaction, but always taking care of the security of these users. The second risk is the smart contract risk. So every protocol should go under proper audit campaign, but this not ensure 100% let's say security to the protocol, because there are always hackers around there that always look into your code. And the third risk is the centralization of the team. 95% of the team of the protocol is centralized, which means there are teams that have control on the protocol operation. But this is not a bad thing, because the team is the one that have the most knowledge about the protocol. So in this case, it's not a bad thing, but we should find an hybrid model where you can involve the community and also the team decide on which operation are the best for the protocol.
So I guess just from a practical standpoint, the report does spend a considerable amount of time talking about risk and risk assessment. So I don't have a legal background, don't have a compliance background, but I do have a practical background as it relates to working for commercial banks, in addition to Polymesh as CEO. So in the case of DeFi, as Polymesh builds out its ecosystem for 2025, DeFi will be a part of that going into 2026. However, DeFi in general will have to meet the same standards as our other non-DeFi partners. And what I mean by that is whether you're a permission chain or a permissionless chain, and there's plenty of white papers on this, we are getting to an inflection point where layer ones in general will have to have BSA AML policies in place. In the case of Polymesh, we do have a CDD policy, so as a public permission chain, we do an ID check in addition to making sure, the person's not on, or entity, or the person's not on the OFAC list. And then with node operators, they have to be licensed. So there is a KYB check. I firmly believe, as it relates to the United States, that any partner as it relates to DeFi, whether it's on the lending, collateral, liquidity pools, will have to meet those same standards. And we're in the process of upgrading our own policies. The Polymesh team just recently, ironically enough, the previous panel was great. Anthony was wonderful. We just recently met with Senator Warren. So I'm from Massachusetts. I might have a little bit of a Boston accent. She is my senator, obviously not exactly pro-crypto. But we did have a great meeting. And she is all about consumer protection, which is not so much about DeFi per se. But she is very much interested in money laundering, right? And so at least in the United States, that is top of mind as it relates to DeFi and the other players who play in the ecosystem.
No, I quickly comment on this. I mean, in DeFi, we also have a sort of consumer protection, even if it's not really highly adopted. But there are protocols like, for example, Nexus Mutual, where you can deposit a funds in a protocol, and by paying a fee, you are basically covering your funds from a potential hack or breach losses. So in some way, it's a sort of consumer protection.
Yeah, I would agree. So if you look at, FTX, Celsius, a perfect example would be Gemini and Genesis on the Earn product. In addition to institutions participating in that product, there were a lot of individuals that also got caught up in it. So it is top of mind. I guess my point is it is top of mind in the United States.
Let's talk a little bit more about the software side of things, though, because that is the core of DeFi, right? Somebody launches a protocol on a blockchain, it's the software. As just a general matter, software developers are generally not held liable for the software that they create. Do folks think that needs to change, either for DeFi specifically or more generally?
Okay.
This is one of the questions that we grappled with in the working group, right? Because if the best you can do is point to the software development team, and then you say those folks are responsible for becoming a regulated intermediary, that would throw aside 50 years of law and regulation in most jurisdictions, because software providers are not held liable.
So just a quick response. So once again, from a practical standpoint, so I headed up the digital asset group of a 200-year-old community bank in Massachusetts. We can debate whether they should have been providing depository services to digital asset
They definitely should be, because we need those services, please.
Yeah, unfortunately, they don't offer that service anymore. But the quick point is we were providing operating accounts and FBOs to crypto exchanges, right? So the Coinbases, the Voyagers. Voyager isn't a good example, but we started to onboard DEX, right? Decentralized exchanges. And obviously they did not have any BSA AML policies in place.
I don't know how you onboard a DEX, because it's just code.
That is correct. So they were making the argument that no, we are a technology platform. And of course, the 200-year-old community bank was like, oh, no, you're an exchange, you should be licensed. And so there's been this fight that's been going on for the last several years.
Maybe I can comment, Lee. I mean, I'm 100% not in favor of considering the software developer responsible for I mean, it's like, it's not a good comparison, but it's like if something happens with Apple products, are we going to the CEO, if the Apple product, if you are using your phone for laundering money, does that mean
So I'm sorry to interject, Hedi. Take this example. Diana programs something that just steals everybody's money.
That's a different, yes.
Well, why is it different than Diana programs something that accidentally steals everybody's money, or Diana programs something that Alan finds a clever way of exploiting such that he is able to steal people's money?
I do think it's different because the nature of, and I want to refer it also to Tornado Cash and the new court rulings.
They're not stealing anybody's money at Tornado Cash.
No, so that's the whole thing. Yeah, I do think there is a difference. If you're developing a software or a specific code and you're benefiting from it financially, which is ultimately only being used or with the purpose for criminal activities, you might be actually responsible. You know, with Tornado, that there are two different things. One of the debates that time when OFAC started sanctioning Tornado, which community, and I myself personally was not in favor of what everything was happening in the scene, was that the question came back and forth, was not the developer, software developer, financially benefiting from Lazarus, for example, transactions has been laundered. You know, that was one part, that where is the financial gain of the software developer? And one part is if they have any control, because it's a smart contract, it's automatically executed on chain. You are not controlling anything. Okay, maximum you do is audit. Okay, you have
and open source.
Yes, and open source. So what is the controlling factor? We don't. You are not monitoring. You are not even in charge of that. So I think that plays a role. Maybe it's a fine line. But it's very difficult to liable and find someone liable for open source. You know, like it just contradictory with the nature of open source.
So can I open it up to the audience?
Yeah.
Anybody have strong views on
I'll give you the mic.
software developer liability? And at what point should software developers be liable for what they code?
Very framed argument, right? I mean, just saying software developer instead of... I think the argument
Instead
is
of
already
what?
framed if you say software developer rather than somebody who provides a service, potentially takes risks, introduces or handles a trade. That's a framing, right? Because in theory, as an exchange who's 80% a regulated exchange, so 80 will say, I come from banking as well, right? So my CEO would say, we are a large software company. You go to the largest exchange and said, we are now software companies. Like, so your argument is, if it's code, it doesn't get regulated. If they suddenly say, hey, we have 80% of our business is code, are we then still liable, even though we touch a trade, we do something with the trade, we take risk? You know, so it's a very tricky argument. Even though I do like the argument, but it's a tricky one, right? Because it opens the door to a lot of other people.
By the way, I don't know the answer, right? I think it's a very difficult question at this point, because pretty much every company is a software company in one way or another these days, right? You're either producing software or you're using software. And the line that's typically been drawn is if you are using the software to facilitate or execute trades, then you're a financial services intermediary, you need to be regulated. But if all you're doing is the coding and you hand that software off to somebody else to use for facilitating trades, you're not liable.
But you would then always then you don't make any money operating it, right? So there is no way, as a software company in the financial services, you do get revenues out of the
tokens have changed all of that, right? So Uniswap Labs makes $0 off of any trade on Uniswap, but the folks at Uniswap Labs have Uni tokens. And so as the protocol grows, those folks benefit. It's not a one-for-one direct benefit. It's not like charging a commission, but they still benefit financially.
Can I quickly comment on this? Nowadays there are measures that can prevent all of this. For example, I will add a sort of self-regulation by adding like a ranking regarding the security of each protocol, and each protocol should follow specific rules. For example, nowadays, what you can do for a protocol to follow all the security rules is, okay, you can do an audit with several auditors, but they don't take the responsibility in case of a breach or an hack. What you can do also is to open the audit to the community. Nowadays there are platforms, for example, Immunify, which is the #1 platform in the crypto space for hosting a bug bounty hackathon. We were among the first protocols that opened this new niche. So the way it works is that there's a fixed amount of time, for example, 2 weeks, where you call all the white hackers in the space and they try to hack your code before you going on mainnet. So this also add a sort of safeguard check mark in the protocol and grant you more reliability. Then you should do also some economic review. We did many economic review because many hack and breach happens also because of lack of understanding of economic operation. So these are the main 3 things that every protocol should perform before going to the market. So if we can add a sort of, let's say, a benchmark, a reference point that every protocol should follow, we can prevent hack, for example, internal exploit. This obviously will not happen because other users will report this in advance. So this cannot happen.
So we had 2 more comments here. On the role of intermediaries, software, and liability. We'll start here with Norma.
Thank you for this. You know, I think the discussion and debate over the use of open source software is broader than what we're talking about in the DeFi community. But there is, at least in the United States, sort of an evolving regulatory regime where it falls on one side or the other. And that is that the open source community should be encouraged to continue doing what they're doing, right? Innovation is really, really important. But the open source community should be incented to ensure that what the code that they're writing is secure, not, you know, best, fastest to market, but we want them to continue. On the liability side, what the United States is saying is those companies who then take that open source software and put it in a product or service that you are selling, in some ways, you own that responsibility 100%, whether the code literally works or functions correctly or not, and then separately on the risk, so cybersecurity risk, vulnerabilities, and other things. So we haven't seen which way the regulators will go when it comes to the products, but from a very high level technology perspective, that's where the US is going.
So you're spot on. So another practical example. So the same deck, technology platform, we start talking wallets. Are you holding any wallets? No, we don't hold any wallets. We're a technology platform. But our clients, peer-to-peer, they have wallets. We're like, great, we want to see those wallets, but they're not our wallets. We cannot ask for those wallets. Well, how do you know if they're doing something illegally? And their response is, it's none of our business.
We had
That's
a comment
interesting because
here and then here.
Sorry,
Go on.
just to
Go on.
respond, this is a good point because anyways, we started, for example, at 1 inch self-regulating ourselves, regardless there is unclarity from regulation. We are not going to wait for them to tell us what to do. And this is what we are dealing with. So we are, for example, just to respond back, is that we provide the infrastructure. So most of the revenue of 1 inch is from integration with Coinbase, integration with some integration with central exchanges. That's where the revenue comes from. It's not from swaps. It's not from trade volumes. So what happens, nevertheless, we monitor all the wallets of the users of Coinbase. We do not trust Coinbase is doing a good job. So what I just give you an example because these cases come to me to approve blacklist, whitelist, what, and then the thing is, Coinbase reaches out. Why my user wallet is blacklisted with 1 inch? Why my user cannot access to 1 inch? User does not know they are using 1 inch, right? We are the infrastructure. We are just embedded. So user only sees Coinbase, but they want to plug in. It says restricted. Coinbase comes to us, what's going on? Well, I can see your user has had interaction directly with certain risk that we are not willing to accept. And I'm like asking, Coinbase was the example, by the way, sorry, it's not about Coinbase. But I'm asking them back, well, maybe you want to check this user with your compliance team because this is what we are seeing. We are not going to let that happen through our, Just to say back, indeed, we don't own the wallets. We do not have any custody over any user's one single penny. Nothing sits with us. Nevertheless, we monitor, indeed, and we do. That's the approach we took. And it has pros and cons. Also, law enforcement queries come to us. They want specific information on certain addresses. And we are like, look, these addresses, they do not have a wallet with us, but we can tell you where is the wallet owner. For example, is DeFi Llama. The wallet owner is with Coinbase. You can reach out to them. They have an integration service with us. And that's all we can say. But also we cannot freeze anyone's, that's when the tricky part is, yeah, we because we do not have the custody. When the freezing order comes, we don't have any power, and that is difficult for law enforcement agencies to understand that we cannot freeze anyone's assets. The max we can do is to blacklist that specific wallet. Yes.
Yeah. So let's move to Alex. You had.
Yeah, quickly on. I don't think anybody wants to regulate software. I think it's about regulating services that those software enables, control over those services, and therefore liability over the control over those services. So Uniswap is a service because you have 6 guys, I don't know how many, who have a multi-sig private key access to the smart contract and can change it anytime they want, deploy a new version, etc., etc. There is a notion of control that automatically needs to lead to a certain level of liability. Otherwise, we all fucked in the world, because we're not talking about software to play a game, a Tetris game. We're talking about software to transfer in value and hold value.
To transfer like the Trump meme coin that everybody was complaining about
it has value.
30 minutes ago?
It has value.
But they were good wallets.
So I'm not saying that every value needs to be regulated.
Let's follow the thread a little bit more.
That's what I'm saying. So service is important here.
By the way, the Uniswap guys actually do not have a key. So they can't change the Uniswap. Other DeFi protocols work differently, but not Uniswap. But leaving that aside, even assuming that they could make updates to the software, for example, to fix a bug, why would that of necessity mean that they should be the regulated intermediary when they have no control over the trades that are done, when they receive no commission from the trades that are done, and when they have no ability to move tokens from any account or stop any trades from getting done or anything like that?
Do you have control or you don't have control? If you have control, That's a different story.
I mean, the way I like to think about it, just to put some of my cards on the table, is who can change the data, right? Who can change transactions? If there is some party that can say Lee's transfer of tokens to Norma gets reversed against my will, then that seems like that should be a party that, right? But if there is no such party, then it's hard to see who should be responsible.
Great, let's move to Gail. You had a comment as well.
We'll go after. I don't think I have any direct answers for you because it's not my area of specialty, but my area of specialty is in standards. So Gail Hodges, Executive Director of the OpenID Foundation. Our standards are used by billions of people across millions of applications, and they're commonly used now in open banking and open data, which is an analogous type of scenario where you've got institutions, large formal banking institutions, sharing data to authorize payments or get raw information out to a fintech. Right, so it's kind of, you could be using open banking and open data to invest in a cryptocurrency or enable a blockchain-based transaction. And the way that those models typically work, regardless of whether they're private sector-led or government-led, is that they're going to use open banking and open standards sitting behind them. And so it doesn't matter what the wallet bit is or whether it's open source or not. The real question is whether there's an open standard sitting underneath of it and a truly viable, consensus-based, transparency-developed standard in the first place. In our case, this is FAPI. And so many, many countries are using FAPI to enable those ecosystems. And the protocol is developed with that rigorous consensus basis. Then you have formal security analysis conducted on it to make sure that the protocol itself is rigorously and mathematically proven not to have any issues that it could be intervened with along the way. And then you're ensuring that the parties that are on both sides of a given transaction, that they have self-certified that they're conformant to it and they maintain that conformance. So you have to have that end-to-end recipe, and whoever is kind of leading that ecosystem has to ensure that the certification and conformance is maintained. Then at least point to point, you're solid on the protocol, and then you have more of an issue on whether there's, on one end of the transaction or the other, there's phishing or there's other problems. So that's a different topic. But having that kind of core capability of open standards and then certification for conformance is a critical core capability.
I want to quickly comment on something, the code, the red code. Yeah, I think. Okay, sorry. Red code. Okay, sorry. Sorry, I don't remember. Red code. Sorry, I don't remember the name. But yeah, before you mentioned that there is no incentive from a community perspective in reviewing the code of each protocol. But actually, there is an incentive because protocols can pull up a bug bounty. So, for example, you can pull up a 1 million bug bounty, and you can attract white hackers to try to, to hack the protocol and check that everything okay. If they find like a breach or a bug, you can then pay them. But I mean, it's a great thing.
I do think there is some incentive, though, right? There's a reason why people go out and do a bug bounty, is because they want to make sure that the software works for the intended audience. And whether that's centralized software that's operated by some centralized company, or it's a DeFi protocol that just sits on a blockchain, there are good incentives to do bug bounties, to do security audits, to do code audits, to do all of that stuff to make sure that the code functions well. And that incentive is so that people will use the software.
Yeah, exactly. And it's literally a work. So there are many people that do this on a daily basis.
Next time you talk with Senator Warren, let her know that there's a lot of people doing this kind of work to try to make sure that consumers are protected.
Look, I would agree. The reality of the situation, if you just move away from DeFi just a little bit and you focus on banking as a service, the number of community banks in the United States that ended up with a consent order, working with a prime trust or Treasury Prime, it's kind of the same situation because, you know, you have Treasury Prime or Prime Trust basically saying, oh, geez, we're not responsible for the KYC. And then, of course, the bank will say, well, that was the responsibility of Treasury Prime. But at the end of the day, you know, whether it's KYC, KYB, identity checks, we're actually working with Finclusive around a credentialing, an ingrained credential ID program where it's already embedded, so we don't have to work with a third-party provider. But back to DEX again, you know, 5 years ago, the bank would only check one wallet. And then obviously chain analysis and others, more sophisticated products and services. When I was the CEO of an offshore bank in Puerto Rico, chain analysis could go up to 10 wallets on a matrix. Man, oh man, that is scary to look at. BSA officer would bring me in, and everything up to number 8, good to go, and that last one was scary. It was in, North Korea, Russia. But anyway, the point is, it is important. At least in the United States, you can probably get away with it in other smaller jurisdictions that are not regulated, non-Westernized. But once again, back to the report as it relates to risk assessment and how you assess those risks.
Can we do a comment from Max real quick?
I'm not sure if you want to hear my comment, but as most of you know, I'm in tax, so I'm with TaxBit, and the U.S. Treasury and IRS dropped some interesting regs on the 28th of December, so also an interesting timing. I mean, it's 99% sure that the reg's gonna get killed through a CRA, so by the new government and Congress in the next days, but the US IRS and Treasury basically followed an interface approach with DeFi applications, basically requiring them to do KYC plus on customers, also collect their tax identification numbers, and also then report on customer activity to the tax administration, right, to the IRS. So basically a transaction-based reporting requirement. Everyone has been talking about AML. I think that tax is actually the thing that we should be most scared of. I mean, US will kill the regs, but the OECD at the same time is negotiating and finalizing the implementation of the crypto asset reporting framework, which kicks in by the end of the year. So my question to you guys would be, we are currently discussing at the OECD level the scope. By default, DeFi is in. Because by default, everything is in CARF, because it doesn't relate to a registration process like FATF regulation. So the question is, and now the question is, which DeFi applications would be required to report, yes or no? And for this purpose, we look at the cozy approach, so basically control or sufficient influence, which is different across all jurisdictions. There is no harmonized cozy assessment approach. What would be the main priorities you would be looking at in order to have such a cozy assessment? So basically, because we as an industry are currently putting forward suggestions on how the OECD should guide participating jurisdictions on assessments of control or sufficient influence over a trading venue that effectuates transactions. So, for example, just using follow the money is definitely not the way to go, but I would be curious about your thoughts.
I'll jump in at the risk of sounding foolish because I don't know anything about taxes, unlike you, Max. I think the easiest place to start would be if you are a regulated financial services intermediary, you have a tax reporting obligation, and if you are not, you don't. So I wouldn't put the fight at the level of the tax authority. I would put the fight at the level of the financial services regulator. And the reason I would do that is because it combines the customer protection issue that I think a lot of people are concerned about with all of the other issues that go along with being a regulated intermediary. And so that's sort of the way that I would look at it. In the US, that's kind of a kooky thing because you might be regulated by the SEC, you might be regulated by the CFTC, you might be regulated by a state regulator, you might be regulated by some combination of all of them. But that's how I would do it. So if, for example, you were a quote-unquote crypto exchange in the US and you were only regulated by New York State, I would still count you as a regulated intermediary for purposes of the taxation analysis. The way the IRS, I was actually talking with Alan about this a little bit before, so my apologies, Alan, for reiterating what I said to you. I think the IRS actually did a pretty good job, even though they were kind of jerks for dropping it on December 28th. Like, they could have waited till January 6th. That would have been nicer, right, for my holiday, but whatever, right? I think they did a pretty good job of saying, you know what, we looked at all of this stuff, and the best place to put this, we think, is on front ends that actually are involved in the execution of a trade or involved in the transmission of an order. Now, we can disagree over whether that was the right place to draw the line, but they took a stand, drew the line, and they explained why they thought that made somebody a broker. So I actually thought they did a pretty nice job there. It'll be very interesting to see whether you're right and there is a CRA process and that it no longer exists. I think that there is some chance that the CRA won't pass. And I think that there is some chance that even if it passes, the president will veto it, because everybody in Washington has to think about how they're going to raise money to keep paying for everything that they have to pay for. And so there are other things at play, but I wouldn't bet against you in this bet.
Yeah, the only thing I would say is I think they don't have to start reporting until 2028 or 2027. I would agree. I think the concept, I get it, right? And, you know, I forget the exact form that I would get if I had a capital gain off of a central exchange. You know, why should somebody else have the ability to go to a deck and do the same thing and nobody's going to ever know? You know, I get that point. But there is a really good chance that the president will probably scratch that and start all over again.
And I don't think DEXs should have tax reporting obligations unless we're going to say that they need to be regulated. We've not got to the point where DEXs are regulated. Just like, frankly, in the US, we've not gotten to the point where the centralized exchanges are necessarily regulated, right? There are states in the US where you can operate a crypto-to-crypto swap exchange and not be regulated at all.
Yeah, I mean, this is a great example of the cart that's in front of the horse. But to your broader point, they are heading in the right direction. So.
Okay, we have like 10 more minutes left. So as we wrap up our discussion, I'll defer to Sylvia again to kind of like, how do we make the best use of our time given the questions we have? Any topic that we haven't highlighted?
Yeah, I think just in general, I know that each one of you represents different areas, specialties, but of course, DeFi brings a lot of changes, and I think at a really fast speed, everything is happening. But from what you've seen, how do these changes affect the markets, and what would be the implications if DeFi were to scale, especially with what we anticipate coming up this year?
Yeah, I can. I mean, I thought maybe we are doing in turns.
Feel free.
Yeah, sure. I mean, I do strongly believe in the future of finance by DeFi. Else, I would not have joined 1inch. You know, and then when the opportunity, for example, came across, I just looked around and people told me, this is the future. Yeah, I mean, go for it. And I do think that would be the, when we talk about future of finance, DeFi is the infinity when we look at the potential. And I do also believe, again, when we look at the volumes of swaps on, it's magnificent on its own, and this is not yet mainstream. And considering, I think the gap or the deal breaker is when we have institutional players getting to the DeFi scene. And that is, that's basically, I think that's the moment, the breakthrough moment for DeFi.
Yes, I comment on this. Oh, okay, the DeFi brings value like permissionless and trustless value, but in my opinion nowadays, I'm going to make an hot take, but I think the DeFi user experience is terrible nowadays, and because there are like every day there are new chains, the people found the flow between one chain to another one. So there are two main problems in DeFi. The first one is the tool fragmentation. In order to make, for example, a deposit in one chain, you maybe need to do a bridge operation, pay gas fees, pay bridge fees, and it's really a pain. For example,
1 inch is automatic swap.
Exactly. I mean, there are protocol like 1inch that do cross-chain swaps. Then there are also cross-chain aggregators that take 1inch into their route to offer the best outcome to the users. And the other problem is also the liquidity fragmentation, because nowadays more than the large majority of DeFi protocol are multi-chain. Multi-chain, it means that they support several chains, but these chains don't talk between each other. So, and instead, for example, Fox Finance is a cross-chain protocol, which means that the protocol can be accessed by several networks, but these networks talk between each other. I did a research on the biggest lending protocol in the space, which is Aave. But this can be applied to any protocol, to be honest. And we saw that Aave has several networks, but these networks don't talk between each other. This means that the liquidity fragmented. For example, if we have a pool on Arbitrum for $50 million, a pool on Avalanche for $50 million, a pool on Polygon for $50 million. The maximum amount I can borrow is $50 million. Okay. I'm not considering the loan to value ratio, but the maximum amount I can borrow is $50 million. Instead, with for example, with the cross-chain protocol like Fox Finance, we work in the way that we have unified pools. So in this case, the max amount that you can borrow on Fox Finance is 150 million, because you are going to aggregate all the liquidity in one place. So this means that you are improving the efficiency of the liquidity, and also users don't have to deal with bridge and gas operation, because you can deposit an asset, for example, on Avalanche and borrow natively on Ethereum without having to close a loan, reopen another one in another chain. So this is where the DeFi is going. There are many builders that are going into the, let's say, the chain abstraction into the cross-chain environment, because these are the main topics that, the main problems that the DeFi is facing nowadays. And this also, to add, help also the users in onboarding new users, because the newbie are facing several issues when interacting with the DeFi protocol. They can also make mistake when interacting with the DeFi protocol, because they are facing this problem.
Maybe I'll add just one more quick thought here, which is I'm interested to see when the traditional markets start to adopt AMMs. I think the AMM technology is getting pretty good now, and there's no reason that the New York Stock Exchange can't adopt AMMs. There's no reason NASDAQ can't adopt AMMs. Not be decentralized, not be a DEX, but use the AMM technology to execute trades on behalf of their customers. So to my mind, I see a lot more cross-fertilization that's going to happen between TradFi and DeFi. And, you know, to some of the stuff Hedi was saying before, if Coinbase is already routing orders to 1inch for execution, then we're going to see all kinds of interconnected marketplaces. What you guys are doing, same thing, interconnecting all the marketplaces. Bill, what you guys are doing, same thing, interconnecting all these different marketplaces. So I think that liquidity fragmentation is slowly going to get stitched together in a lot of really interesting and creative ways, some of which might allow us to do some really cool, sophisticated yield farming, especially when I train my AI agent to do it for me.
One thing, I would like to comment, because I like that you mentioned the AI agents, because I think this could be a game changer in the DeFi space. I mean, nowadays there are people that are building AI agents because they think that they are going to replace the UI of the application, not the back. So by totally abstracting the operation for the users. But I don't think this is the proper way, because the more you abstract, the result you will get is not that the result that you want to get, the best result that you want to have. So the way I see the AI in crypto and in the DeFi is that the AI will become your DeFi assistant. So as soon as you enter the DeFi application, the AI help you and guide you in all the operation. I see this like a Pokemon. So based also on your regulator. Yeah, exactly. So based also on your trainer experience, the AI suggests you like the operation that you want to do, the best outcome from a different operation. It can also help you in building things for the protocol. So this could be a game changer from a AI perspective.
I'm going to name my first AI agent Pikachu in honor of you.
Can we KYC that agent?
No, obviously.
It's just software, no responsibility.
That's what they say.
All right, let's close our time together. Thank you so much to Lee and Sylvia for moderating the way you have, and for Bill, Hedi, and Filippo joining us, as well as all the community. You've raised very, very interesting points. We could go into this in depth, and it would take us days, but we have to wrap up and get to the next panel. So thank you so much.
Thank you very much.
Thank you all.